What a roller coaster of a week. I feel like I keep saying that over and over and over, but once again, we're up. As a matter of fact, this is the second week in a row that the indexes have closed green, at least the indexes that matter the most. Guys, my name is Hamilton. I'm here at the Trading Initiative, and this week's Markets in Focus, wrapping up the week ending May 3rd, 2024. Let's talk about, was that the bottom on April 19th, about 2.5 weeks ago? Well, potentially. Check out what is outperforming on the week here, though. Emerging markets up 3.11%. This is a new theme that might be emerging. Something we're going to look at a little bit more in depth on the trading view portion of this. Something that you should probably be aware of because there are a lot of opportunities to potentially be owning stocks outside of the United States right now, specifically if they're starting to break out into these secular bull markets. A lot of these have not participated yet in the last 18-month run. So emerging markets, potentially some new trades coming up. The 20-year plus Treasury bond ETF up 2.12% on the week. I don't know if I can understate how important it is that bonds are not going down this week. We've talked about this a lot over the last 2 to 3 weeks, that if we're expecting some sort of floor to be found, bonds need to stop capitulating. And they did for the first time this week. They stopped going down. They're up 2.13% as of filming this Markets in Focus video. Definitely think that's a huge part of the reason why the markets have been able to rally this week for the second week in a row. That bonds are not going down anymore. Remember, bonds and the equities market are highly correlated right now. The Russell 2K is up 1.63% as of filming this, up and over its $200 price limit, meaning next week we could potentially be owning smalls and mids again, at least inside of TTI. The S&P 500 up 0.55 on the week. Q's up 1.08. Not huge moves, but definitely week over week progress. And that's what we care about, right? Was that the floor on April 19th? Well, first things first, things need to stop going down. And now we have week over week indexes closing up. Check out the things that didn't perform well this week. Crude, down 7%. 7%. Is the energy trade done? Not entirely sure, but this is not a great look for oil, particularly oil bulls. Bitcoin down 4.6%, kind of within reason. Something we talk about inside of TTI all the time is if you're trading a volatile asset, particularly if it's hanging around near resistance, you have to be okay with holding through some of the ebbs and flows. Obviously, we have our line in the sand that we want to cut the Bitcoin trade, but we've been long Bitcoin since about 28.5, 29 back in October 2023. Do we really want to sell the entire position up here? It just doesn't feel right. Still, though, down on the week, 4.6%. We have, obviously, commodities are down along with oil, and we have yields down. Was the 19th the bottom? Was it the floor? Should we be buying stuff with a lot of size? Let's go through some sector stuff. Things are starting to emerge, starting to get a clearer picture. Big question here in a sector performance. Let's go to the 1 month. Did higher beta areas of the market bounce along with the market bottom? If April 19th was the bottom, I would expect higher beta areas to react more. Tech, consumer discretionary, communications the most. Over the last month, tech has higher highs since April 19th. That's step number one. Communications, trying to stamp out a higher high. Consumer discretionary, trying to stamp out a higher high. These are very constructive moves to the upside. Not completely out of the woodwork yet, but this is what we want to see. We want to see improving higher beta sector performance in a bull market. Generally, when you see defensive areas of the market outperform energy, staples, utilities, you can reasonably expect a risk-off mentality in the market. We're starting to see some of the higher beta stuff, the more riskier stuff, outperform. Look at it from an industry standpoint. Check out gold miners. They were doing pretty good for about a month and a half. Where did they go from here? They've completely stalled out. Regional banks, trying to make a stand here. Great for financials if you're long financials. That is not a defensive area, by the way. Software, finally, Apple reported. Trying to find a floor here. Software has been kind of the weak link in tech this year. Semis. Are we starting to catch a bottom? Potentially. Remember that April 19th date is a pivotal date. That was the capitulation candle in most of these areas. Are we up from there? Yeah, we are. We're starting to gain some ground back to the upside. We're not out of the woodwork yet, but definitely a lot of progress. Check out some of the higher beta shit stuff. Clean energy, April 19th bottom. We've rallied like crazy since then. Not saying we're trading any of this stuff, but the higher beta shit stuff, if it's moving, might be indicative of a bottom forming. Solar names, up off of their early bottom, April 16th, potentially April 19th. Yeah, we're starting to see some improvement here. It's not the best, but it's improvement. Factor analysis. What we want to see here is some of the value stuff in a relative decline, some of the growth stuff popping back up. What have we been noticing? Well, large cap growth. Bottomed on April 19th. Higher highs since then. Small cap growth. Bottomed on the 18th. Uptrend since then. Once again, we're seeing it. We are definitely seeing it. We have to mirror that, though, with some breadth improvements, some market internals, etc. Now, this is a fantastic gap. Don't get me wrong. Inside of TTI, I know I've mentioned it on YouTube before. The speed at which a gap gets filled is generally indicative of the strength of the underlying trend. Meaning, if the market wanted new lows, you would have expected the Qs to sell off and fill the gap to the downside, at least today. I don't want to say aggressively, but today, and it didn't at all. Matter of fact, we're continuing to push here end of day. Higher highs, going back to the beginning of the April sell-off on the 15th. Hard to hate that. Back up and over the 50 on the RSI. That's a Q for us. SPY. New highs going back to April 15th. RSI back up and over the 50. IWM. Higher highs going all the way back to the beginning of April. RSI above the 50. We're seeing participation in the areas of the market that we need to see participation to really start getting long with conviction. And we are long right now, right? We've talked about it this week. We're not afraid to dabble. We put some new positions on the books. We put an Apple position on the book. I think I mentioned that a couple of days ago. It's performing well for us so far. We're up about 100%. We're able to hold these things for an extended period of time now. Check out bonds. That hidden bullish divergence down here, right? Series of higher lows here, lower lows here, showing you that potentially momentum into the downside is starting to wane. Gives you a general idea that there could be a reversal coming, not necessarily a timing type of idea, but an overall, hey, if you're looking for a reversal, it appears that potentially it could be coming relatively shortly, and we're starting to get it, right? Bonds up into a new 2 or 3 week high. That has allowed the market to rally. The dollar, we've talked about it, below 105.5 opens up the opportunity to attack the 200-day moving average. We break this range. I don't know what that was. We break this range. Market probably rallies. We broke the range. Market rallied. Question. Is this short-term trend to the upside over? Or is it something like this? If it's over, I think it's reasonable to expect we're going to come down, test the 200-day moving average, and if we break it, that will probably give the market the opportunity to jump back up towards all-time highs. Remember, the dollar is the most important thing here. What caused the dollar to start crumbling to begin with? Well, the Federal Reserve announced that they were going to quicken the easing of QT. The dollar immediately responded to the downside. And then we had a bunch of data come out today that was absolutely terrible. And it allowed the market to start pricing in the fact that maybe there will be some rate cuts again, of course, causing bonds to get bought and the dollar to get sold. Kind of a perfect storm here. It's not because of Apple, although we are long Apple. Not a bad little move. Arguably the most important stock in the market other than Nvidia. Absolutely abysmal earnings, and they don't give a shit. They initiated the largest stock buyback in history. I see people on FinTwit and YouTube crying about it. I don't care. I'm happy. I'm up over 100% in this position. I don't give a shit about why the stock's up. I care about the fact that it is up, and I was able to time it correctly. As technical traders, we don't necessarily give a shit why the stock does what it does. We care about being able to identify opportunities, high risk to reward, multiple times, repeatable processes, and make some money while we're doing it. So we know the dollar potentially breaking its short-term uptrend. Bonds starting to catch a bid. The index is catching a bid. Guys, kind of feels like you should probably be looking at your favorite stocks right now if you don't already own some. We have a bunch. Let's talk through that emerging markets theme really quick, particularly with China. China has been a tough trade over the last two to 3 years. People have been wanting to own Chinese names since BABA started to break down, and that has been to their own detriment. A very tough area of the market to buy and expect any sort of actual return. Going back to the initial breakdown, we'll say back in early 2021 once it broke its 200-day moving average. Now, this is QQQ, your Chinese internet ETF. It's not an individual stock, but it shows the overall market sentiment for Chinese internet stocks. And it hasn't been great. We've been trapped underneath this 33.5 level for like 2 years. That's our line in the sand in TTI. We said above 33.5, we want to get long this particular area with size. But we're starting to see something we haven't seen in 2 to 3 years. Some momentum finally coming in, breaking above the 200-day moving average, and potentially, along with other emerging markets, giving us an opportunity to front run the 33.5 area. Now, here's the problem I have with most people. When I say Chinese stocks, most people think of BABA. This stock sucks. We're below the 200-day moving average. You're stuck in a range. You're trapped underneath 124.5 that has held multiple times. Most people go, Chinese stocks, I want BABA. Don't do it, guys. This is not financial advice, but if you're a technical trader, respect the amount of volume on top of where you're trying to buy. It's going to be a very tough trade, even if it does work. There are easier setups out there. I'll give you a couple examples. YMM. Check out that, above 950. There's no overhead supply that you have to fight through. Not bad. Check out the stock that we opened up a couple of days ago, JD. Nice little bottoming out, inverse head and shoulders reversal up and over the 200-day moving average. We're up anywhere between 75 and 125% in this today. Able to take some off and turn it free for the long term. Anywhere between August through January contracts we bought. It's not just these two, though. I want you to go and do your homework this weekend. Chinese stocks are moving. Now, this has happened before. So I don't want to sit here and say go out and own all of the Chinese stocks. But I'll give you the scan that I used this morning that I uploaded to our market research portal. If you want access to this, newsletter is below. It's free. I'll send you all the information. Just sign up. We had 14 names earlier today. They all looked pretty okay. I filtered through by market cap, tried to get rid of a lot of the stuff that was just impossible to trade, particularly on the options chain, and charted through all of them. BABA's on the list. BABA is not the best possible Chinese trade out there. YMM, BZ, and the rest are going to be just for the members. Go and look at this stuff, guys. It matters because if this is a secular breakout, which it very well could end up being eventually, there is a lot of pent-up demand over 33.5. Look at all of the accumulation that financial institutions have put into Chinese stocks over the last 2 to 3 years. This is a very nice stage 1 base being built. Does it finally break 33.5 and give us the green light to go in with size? Well, it sure is nice if we're able to catch a couple of these early at logical levels. So JD, a position that we're happy to be in right now. And then obviously, we've opened up a bunch of different positions I'm going to show you really quick. None of these are particularly huge positions, right? The market still kind of shaky here. But if you look at the Discord, if it actually pulls up, I don't know if it's going to pull up. Let's see if we can pull it up here. There we go. This week, some of the positions that we were able to get in. A lot of day trading this week because the last 2 weeks have been really, really fruitful for day trading, but not normally something that we do a whole lot. Some of the Apple plays, but you see what we're going for, right? We're not afraid to commit capital, but we're doing it at logical areas and with decent position size, and we're not going all in. Last thing I want to talk about really quick is that market breadth is not necessarily confirming the move with the indexes. The indexes are up into new 2 to 3 week highs, which are great. Don't get me wrong. We're up and over the 50 RSI. We love it. I mean, that's step one for us. But it's not just the indexes that we look at. We look at market internals as well. If you're only trading the Mag 7 stocks, it's a fantastic day, right? Your Microsofts, your Metas, your Amazons, your Nvidias, your Teslas, etc. Great day. But if you're looking to trade other things, which most people are, confirm the index move with some equal weighted ETFs. Once again, I want you to look at SPY. We have a new 2 to 3 week high in SPY. If we go down to RSP, which is your equal weight S&P 500, we failed to hit a new high this week, right? Monday was the high point. So even though the non-equal weighted ETFs are hitting new higher highs, the equal weighted ones are not. Check out the Qs. Couple week high there. QQEW. failed to hit new highs. Not saying the indexes can't continue to rally, and I'm not saying breadth can't catch up, but I am pointing out right now that market breadth is not totally agreeing with this move as of today. So once again, was that the bottom April 19th? Potentially it could have been. Is it enough for us to want to go full 1R into every position and deploy most of our capital? Probably not yet. We're in a bunch of good stocks right now. We've been slowly collecting them over the last 2 weeks. I think we have a pretty good grouping, bunch of different sectors and industry groups. It's been a very good week for our portfolios, but I don't think we're out of the entire the woods yet. I'm trying to think if there's anything I'm missing here, but there's just a lot of stuff here that's going on. It's messy, right? Bottoms are a process, not an event. We talk about it all of the time. The key here is just to watch the dollar. The market is going to move along with the dollar. An attack down at the 200-day moving average and a potential breakdown gives this juice for a potential all-time high run. I would assume that market breadth catches up then. Right, guys? Last thing I'm going to say here, it's very, very difficult to short a primary uptrend. You have to be almost perfect with your entry. Almost perfect with your entry. Because if you're not, every dead cat bounce is going to destroy any premium that you had on those puts. And the worst thing about it is if you're bearish and you're shorting every single dead cat bounce to reload into new lows, eventually it's going to be the bottom. And instead of flipping bullish and identifying that the easier trade is to the long side, the bigger trade is to the long side, mathematically you make more money being long than short, you're going to continue to short the uptrend and potentially blow a huge amount of the money that you made shorting to begin with. But you're also going to miss buying the best positions at arguably the best time, which is somewhere near the bottom. Very few of us actually time the bottom. So don't become so entrenched in a bear mindset in a primary uptrend that everything has to go to zero because statistically you're on the wrong side of the bet. Guys, my name is Hamilton. I'm here at the Trading Initiative. If you like this type of content, please like and subscribe. It was actually a very good week to be inside of TTI. I'm happy with how we managed everything, the positions that we have open. We'll see if the strength continues next week. Catch you on Monday.